Good day, fellow investors. I'm researching stocks based on my research platform subscribers' suggestions, and there is a lot of interesting situations that I also wished to share here on YouTube. In this video, we're going to go through 10 US listed stocks, very differentiated, very various, a lot to hear about. I'll put the timestamps stock by stock in the description below if you want to jump directly to what you are interested in. Let's immediately start. If you like, I'm looking at many stocks, so please smash that like button for more of these overviews of what I have found. So let's immediately start with LKNCY. If you look immediately at the gross and operating margins, here you see that those are very volatile, and given the supply chain situation and everything, 2021, 2022, those margins for the processing of copper and making wires really exploded. But these margins are 3x the historical, let's say, average margins. So if you look at the business, yes, now everything looks great, low PE ratio, improved market cap. They are spending a lot of money on buybacks. I don't know what the spreads on processing copper will be going forward. When I look at the company, I see high stock compensation, and with the buybacks here at high stock prices, not here, I see that the management is focused on pushing the stock price as high as possible while the good times last. Possibly they also understand that the good times might be over, or will certainly be over, when the margins return to normal historical margins, and they want to squeeze as much as they can for themselves because they are compensated with shares, which tells me that despite the great fundamentals, this is a very risky situation now. So nothing for me there to follow. These booms are extremely difficult to predict. You have to wait decades for such a boom to happen here and there, and therefore now it is more risky than it was in the past. Things will sooner or later normalize, the spreads will normalize. Therefore, I see this as risky. Arek asks about the SAP Global financial information, those that do the ratings and things like that. Okay, very interesting business, likely a very good business. They survived their rating debacle. Nobody accused them for AAA ratings, but okay, they survived that. And then we have had the best decade and more, 12 years in the history of financial things, because due to zero interest rates and everything, and now interest rates are going higher, which means it's not that easy to, let's say, make money and everything, but still, everyone expects that this will replicate itself in the future and are willing to pay a P ratio of 50, a dividend yield of 1%, which for me, despite the good business, is too extreme at these market levels. If the market goes down, this will go lower. They just merged, huge goodwill on the balance sheet, huge market capitalization, for past good times that might or might not replicate in the future. So for me, too expensive, and I'll better go to the next one. Now, Omar asks about Brookfield Real Asset Income Fund. There is this infatuation with many for stable income over time, but that is what this should have offered. However, I will question that and say that the Brookfield Real Assets Income Fund is not about real income, is about the fees for Brookfield. And then they sell you exactly what you want to buy, and they make a fee by selling what is easy to sell. not by doing what is really possible. The dividend yield has been cut, so it's not 18, but as it has been cut, the stock is down. I think we are still now at 11%. And Omar asks himself, is it sustainable to put your money there, enjoy 11% on a monthly payment, so great returns there. But if you look at the situation there, this is in the low 20s, the stock price, and then those who bought, yes, got a few years of dividends, but now we are in the very low teens. So this is 50% down over 6-7 years. Even with the dividends that were not 18% here, you didn't make much money. So when it comes to these income funds, as they do too much, to risk too much to give the high yield, sooner or later they have to pay for that when the situation changes, and therefore it is extremely risky. And I'm sorry for those people wanting fixed income. Of course, you are a little bit too greedy because you chase high-risk fixed income. Why high risk? Because this is securitization at the third potency. So they are not investing in infrastructure. You cannot get 10% in infrastructure. You can if you borrow and then invest in corporate credit and then play on the spread. Until that spread remains stable, you get your great yield of 10%. But if the market starts to work against you, securitized credit, do you remember the financial crisis or not? So they are creating a product that fits who wants to chase that product. They think it's stability because it is real estate. No, it is financing, financial engineering, and the only safe thing here is the fee. 2.76% fee for what they are doing, and I think this fee says it all. Plus it's risky, it's attractive. They create this to get their fee, and that's what Wall Street does, and you have to be very careful when dealing with Wall Street. The next very interesting suggestion by Giorgio, Park Lawn Corporation. The business did great in the past, only to see it go down and go down severely lately. Okay, Park Lawn Corporation is a funeral business, so okay, less business after the pandemic, and maybe it is just returning to normality with a P ratio of 22. It is a very interesting business, of course. As people joke often, there are no recessions in that business, but if you look at the business, you also see nothing bad there. There is growth, they are investing, they are constantly increasing revenues, improving earnings, adjusted EBITDA now stable, perhaps a little bit lower after the pandemic. They are growing, they are expanding their North American footprint. They want to grow more. The industry landscape is positive. It's still a very, let's say, mom and pop businesses, and not really, let's say, for the big businesses. Service Corp International is the big one there with 4 billion revenues, and there you have these small ones that take still just a small part of the market, and by acquiring other smaller companies there is potential for growth. Now, very educational here, the most stupid chart you can see in an investor or put in an investor relation deck is how you outperform the market for 6 years, and then your stock goes down and the market suddenly outperformed you. But their business is betting on the chickens to come to roost eventually. We are all getting older, and there is one final certain outcome for all of us, and they are betting that they will make money on that. They want to double their EBITDA over time, nothing wrong with that, and earnings exceeding $2 per share, which would be a P ratio of 5. So if that happens, the stock will immediately double. There are plenty of acquisition opportunities there. They're also investing in growth projects, refurbishments, improvement, quality, and everything has been growing up till now when we have a small decline in net earnings, but EBITDA is still there, which means that the interest on the debt, the depreciation and amortization is starting to pay toll a little bit on the net earnings. But if you adjust for things, okay, still making good money and $0.93, and the target is $2 per share. Now, when it comes to the issues, they grow by giving out equity. You grow by issuing equity when your equity is expensive, which has been the case in the last years. Now it's not that expensive, so they should grow with other ways, not giving away cheaper equity. And if you look at the number of shares, it went from 13 to 34 million in the last 5-6 years. That's a 3x dilution, which tells me, okay, they are using this business model to grow. And for me, business models, because those work until they don't. So you give a lot of equity, you dilute, and if your earnings don't grow more than what you have paid in equity and in money, then it all backfires, and just a small, slower growth in earnings per share has also hit the share. Now, another thing to watch that I don't understand well, and I wasn't even that interested to dig deeper, but if you are investing here, you need to understand the long-term liabilities on what they took the money in for and what will those expenses be as their customers come to them, unfortunately. Because if you take money now and promise a service in the future, if there is higher inflation, those costs in the future might be much more than what you expected in the past. And that is the liability game that can play difficult things with insurers and also with funeral things. So this is a little bit on the too hard pile for me. It's still not cheap that you would say, okay, let's dig deeper. It's now fairly priced after the pandemic exuberance. Also check these liabilities if you are interested in more. All right, Paramount. Someone will make money on this bet, but you have to know what's going on. So Roman asks how, if things play out, it could make us fortunes. And now, what is going on here? And then you say it is a great value investment, because if you look at the value of the content of the platforms, that must be valuable more than the 8 billion of the market capitalization. There are some properties, I think there is a few billion, or some estimate 2 billion in value more than what it is on the books. They will likely sell some of their properties. They own the CBS Broadcast Center, things like that in New York. So that is something. 860 square feet of office and more, the Paramount Picture Studio. So there is some hidden potential value there. Plus there are the movies, The Godfather, things like that, Indiana Jones, that there is perceived value when you think about the brand and everything. But when I look at it, those things for now are relatively losing money, because it's not just about the value, what it did cost or what the brand is. It's also about the cash flows that those things are bringing in. And the cash flows are going to, okay, streaming, direct to consumer, because everyone is doing that, but that's not as profitable as one might think it is. Then we have constantly these programming charges as they switch something, as they pay for their contract. So it is more profitable for them to pay to not honor contracts than to simply air the thing and distribute it. So such changes tell you about also the value of the brand and the ideas there, which makes it also risky. And you can see everything by looking at the cash. So first they had 6 billion, then they had 4 billion, and now after a year they have 1.7 billion. So it is a business that is burning cash, and when you are burning cash, you're betting on a turnover. Okay, they say their assets are worth 55 billion, but there is 16 billion of goodwill, 16 billion of programming, other inventory that we don't know whether they will get in the future at the present discounted value, 16 billion and more. Plus there is always the 15 billion in debt. And then when you compare things, questionable value of this, how much you can get is always how much someone will pay for it or how much money you can get for it. And therefore, when you look at the equity, 23 billion, minus the goodwill, minus this, it's very quickly it gets to 7 billion, which is the market capitalization. And then you never know where will this go. It is likely that someone will make money not on a long-term cash flow machine, but on a takeover, on some companies trying to get in, split it to pieces, sell it for more money. But that period that we have enjoyed the last 15 years with plenty of liquidity, now with higher interest rates, it's also more difficult because you need to make money fast. And if you need to make money fast, there is also the willingness of selling this, splitting it, etc. And for long-term investors, I think it is unlikely that this will be a long-term cash flow machine, because first they need to lower the debt. Maybe they do that, but then again, there will be issues forever. So the hope is for someone to come in, take it over, you make your 40-50%, but the risk and reward is not really attractive, because I don't like risking 30% down to get 30% upside. That's not real investing, so Paramount is unfortunately a no for me. Designer Brands Misha here suggests that we look at this retailer with 140 million of free cash flows, 60 million assumed dividends and 40 million buybacks, thus 100 million in shareholder returns. The market cap is 700 million, which would give an adjusted P/E ratio of just 5 for a free cash flow yield in the mid-teens. There is 330 million of long-term debt, and should 2x or 3x in the next economic recovery. The risk is always this is a retail business. If we look at the stock, it has rebounded a little bit, but is still relatively subdued, and especially very subdued when we look at the last 5, 6, 7 years. So we can take a look at the brands: Vince Camuto, Jessica Simpson, JLO, Hush Puppies. Okay, something rings a bell here or there, but when it comes to fashion, I have seen many fashion stories that look good until they don't. The industry is too fickle for me as a value investor. As Warren Buffett says, retail is the widowmaker for value investors. The debt is slowly and steadily growing as they acquire these brands, and what looks like that they need to constantly do acquisitions to grow or keep revenues intact, which piles the debt there. And as these brands enter and exit consumer preferences, it becomes hard to manage the debt long term. So I don't know whether this is sustainable for the long term or not. Anything can happen with fashion businesses. It can triple in the next year depending on the growth and how the market sees it. But for me, I know enough to stay away from 99.9% of fashion businesses. It's the same risk and reward with pharma. Perhaps even more with fashion, because there is more risk and less reward than with pharma or similar risk. So if you nail it, you big win for a while. If you miss, you can lose your shirt. The next suggestion is from Maurice. We did JD on my research platform, DOCU. Ericsson and Nokia will do in the European part. So we have here an ARK investment idea where nobody would ever sign a document again with a pen. However, the market loved it, especially as ARK was pushing the price up with the inflows, and then the market suddenly started hating it, and we are back to pre-tech bubble bonanza, whatever. I remember something very peculiar for this kind of situations. I remember Cathie Wood saying how she would have helped Tesla if they needed the money. I think it was in 2019 when the company almost went bankrupt, when Elon Musk said they had 2 weeks of cash to survive. However, the environment has totally changed. Even ARK doesn't have the money to fund new rounds of financing, of growth, of investments. Everyone has retracted. The complete venture capitalist and private equity markets have freezed, and therefore when the money dries out, this is what it looks like when a bubble that we here on the channel have clearly pointed out it was a bubble. So you're welcome to all of those that I saved 90% of their portfolio. Unfortunately, if you listened. But with those businesses that constantly need money to survive, unfortunately the bonanza is over. And you can see here the recently additionally paid in capital just jumping, and then that tells me, okay, this is not good enough to be a sustainable business on its own. VC funding for startups. There will be great startups. One of the best startups are created in recessions because they know how to run a business to survive. When there is plenty of funding, they splurge on crazy things, which is a risky behavior. But you can see here the decline with tech investments, and therefore that is what hits also the market and the stocks. The first thing when I look at DOCU is stock-based compensation. That is insane. So it is a fifth of revenues. So huge compensation for the managers, and fifth of revenue is a lot. But they are still growing. They have a good position in the market. However, I think that many of their clients and customers also will have to retract a little bit because likely everyone using them it's cool. So also these businesses have less funding, will have to calm things down a little bit, and we are back to normal business. They also have a competitor with Adobe, so a normal growth business that they are still investing. But when I look a little bit deeper, we see short contracts, so average length 18 months with 46% shorter. And then when I look at the revenue, the growth has slowed down, which is logical, but we might see also the first decline in customers coming ahead. It has already been very bad for 20% of the workforce that lost their job, unfortunately. And then I'm thinking, if they are losing workforce, which is usually sales teams, which means that they are prepared for lower things going ahead, lower growth, and therefore this becomes a normally priced business with a fifth of it going to the management every year. That's the whole business in 5 years. It is too risky that it will look ugly long term. Therefore, not for me, even if the business might be interesting or okay. The next one we have is Simon suggesting international flavors and fragrances, where we all get in touch with their products 40 times a day on average. There are some peers, all hidden champions. It crashed 43% in the last 6 months, has a 5% dividend yield, and a stock price below book value. I think the book value should have some goodwill. If I remember analyzing this 5-6 years ago, when they make a huge acquisition. So there is always tangible and intangible book value to check. The stock price 17 billion, and big decline here, really a free fall. And this then comes back to the acquisition merger situation, how those things work. In the first year you make a lot of money and the market thinks you found the holy grail, acquiring, synchronizing, synergizing, whatever, but then the cycle turns really hits you and things don't look good anymore because suddenly your debt is 50% of the market capitalization. And I have looked a little bit, okay, here they have goodwill from 1 billion to 13 billion. There goes your equity and book value. Equity is 17 billion, so actually it's not trading at book value, it's trading at few times book value. Huge debt pile, and if you don't continue on the expectations when you do that acquisition, usually when things are the most expensive, this is 2021, of course, bubble takeovers, typical Wall Street, and now goodwill will get impaired, etc., and everything will look ugly for a while, plus the debt is costing more and more. And you can see already the impairment of goodwill. You can see here net income already negative, and also if we deduct for the impairments, it's still not really great. They have paid a dividend, but who knows, maybe we will see a cut. But the key takeaways is that results reflect broader macroeconomic challenges facing the industry. And then my question is, there will always be macroeconomic challenges facing the industry here and there. That's typical for any business, but when you make a big acquisition, when you get those fees, you increase your salary and everything, you swing your to show your bigger plane, etc., you don't think about, why never nobody thinks about the price paid in relation to changing macroeconomic situation. So what if the above is the new normal? Beyond Meat and all those crazy things, ordering ingredients hand over fist, are gone. Every Instagrammer having their own flavors, etc., etc. So they rush to do an acquisition when it's expensive. Now you can expect a few years for that to clear out, and then you're back maybe to normal when the CEO gets fired or resigns with the golden parachute. Too much Wall Street for me there. Plus, they are focusing on the best businesses and selling divestitures to get some money to cover the debt. And even if things really improve, if they make $1 billion in 2025, the P ratio will still be 17, which is still expensive, thus more room for things to go lower. The next stock is Lilium. Bjorn suggests Porsche. We did a video already there. And there we have electric jets with electric motors. Okay, they went public again when it was very profitable to do so. However, since then the stock is down 93%. The first thing to understand is that there is no security in the investors backing the company. They invest a little bit in everything, and what sticks, sticks. It's like throwing pasta at the wall and see what will stick. So not that they will chase their 1 billion that they have put in. Those were crazy time. You could get ahead with crazy ideas, and the question is, can they become profitable? Can they survive on their own? I don't know. This was very interesting 2 years ago. Now, if the interest subdues, because 2 years ago, 1 year ago, it was still interesting to fly these things, carry people around. Now, very difficult. Plus, they need to get approvals for this to fly all around the world, and with such a small market cap, I don't think they can survive without new money injections at current level. So it's different to get funding at 10 billion, a round of funding, or now. If they need $500 million to put that plane up, it's very, very hard. And perhaps those that have lended the money to the company will just take it over, sell it, or who knows what. But it was a very, very expensive IPO. But these were the crazy times to do that, so congrats to those that have done it. Now, Canadian Solar, we made a video on it already. Check it in the link in the description below. JD, unfortunately, I cannot speak publicly because it's now a covered stock on my research platform. You can check it there. And we have Luckin Coffee. David suggests that Luckin Coffee, apart from the muddy water accounting shenanigans, they survived and now it's still growing crazily. And when I look at this, okay, I'm thinking, what's the competitive advantage? Okay, they survived this, congrats, but still, accounting shenanigans once are not the guarantee, okay, they learned their lesson and they will just continue to do. They're growing extremely fast, that is right, but now they are fairly priced. But to be honest, I didn't want to check here because I didn't know what to say, to read Chinese, etc. So I stood away from that. Okay, you can say it was a mistake, but I'm not chasing these situations. Then my question is, what prevents, if this is a 5-year-old company, what prevents someone else to do the same? Therefore, competition, everyone is going after them, even Starbucks, etc. So they might grow. And then there is always the question on what are the real profits also of the franchisees, not only of them, and how that is accounted for. That will only be seen in the very long term. I hope you enjoyed this. I'll soon do 15 European stocks that are listed. Thanks for watching, and I'll see you in the next video.